Industry experts discuss the turbulent yet insightful year in the Canadian market. With 2025 just around the corner, we uncover the lessons learned and the road ahead for the construction industry.
Hello everyone and welcome to the final Construction Insurance Power Panel edition of 2024. Yes, each quarter we've been gathering some of the biggest names in the Canadian space to give us their verdict on the state of the market, and now with 2025 looming, we're going to wrap up the year together. Joining us this time we have Colin White, Director, Senior Client Advocate, Canadian Construction Industry Vertical at WTW. And Chris McLean, Managing Director, National Leader, Construction and Infrastructure at Aon. So welcome both, and looking back on 2024, which events that impacted the construction sector stood out and what were the lessons that you learned from them? Chris, you're an old hand at this, so I'll start with you.
So we certainly saw some cat risk type losses over the last few months, and they may have an impact, but I think what's had most of an impact, or more of an impact, would be what we've seen with two things. The recent court decision in the United States around Leg 3, which really caused some consternation among underwriters and had them really reflect on whether or not they'd be interested or willing on offering that coverage extension. And that just a reminder for the listeners, that coverage extension is found under the builder's risk policy. Not all builder's risk policies have Leg 3 coverage. Often it could be Leg 2 or Leg 1. Leg 3 is the most broadest coverage, and certainly to lose it would be a challenge for the marketplace. I think that as times passed, we've found that insurers are more willing to offer the extension now and are not as concerned, but it certainly caused some challenges at the beginning of the year. And the second item would be just wood frame and the losses that have happened. Every few months, we seem to have a very large loss. There was a $30 million loss in the middle of summer in Vancouver that probably caused a lot of concern among insurers. I think that's always going to be a challenge, but wood frame is certainly how that market goes up and down is really a challenge for insurers, for clients, and for brokers.
Chris has done a great job of setting the scene for us there, Colin, but of course we can't talk about 2024 without touching on those severe weather events that we faced, can we?
No, unfortunately, the summer of 2024 will probably go down in the books as the largest loss season in Canadian history. Models have losses for the 2 months over the summer exceeding $7 billion, with the 2024 losses approaching $8 billion. And that doesn't even account for the current events, flooding events occurring on the West Coast as we speak. These catastrophic losses, severe weather events that we're seeing across Canada really have affected the construction industry in a couple of ways. First being the reconstruction and restoration activities that follow immediately after these severe weather events has added additional demand on the already strained construction labor market. So that really does have a trickle effect to the broader industry. The projects are already struggling to deliver and be substantially completed within their given schedules. And now with additional labor constraints, it's also affecting the broader industry to be able to deliver projects on time, as well as a reminder for project owners that no projects are immune from damage and loss events from severe weather events, no matter where you are in this country. So it's really important that our clients and owners and developers look at their force majeure clauses, look at their relief events clauses in their contracts, and as well make sure that they understand how deductibles apply, who's on the hook for paying deductibles as a result of these severe weather events and cat losses. It's a really important item to note as well. Any project affected by a severe weather event or cat loss likely won't make money. So it does have a detrimental financial impact on these projects, regardless of whether or not insurance responds. It does hurt the margins.
Colin, I'm going to stick with you for a minute, if you don't mind, because when we're reflecting on 2024, I think we have to talk about the capacity levels as well. And it was a report from your firm, WTW, which said that the global construction insurance market was seeing a notable increase in capacity levels, approaching those seen in 2019 during the last soft market cycle. So with the market seemingly competitive again, how do brokers separate the best policies from the rest?
Absolutely. We are seeing an increase in capacity, not only in the global market, but specifically in Canada as well, from domestic insurers and Lloyd's of London. That really has created a much more competitive environment, which to the benefit of our insurers. So differentiating good terms versus bad, it is key for us. And what we're seeing is that the restrictive warranties, the restriction on extension of coverage, those are coming off. So we're seeing markets quoting much more commercial and competitive terms, which is ultimately to the benefit of our clients as well. When it comes to retentions, the retention levels being entertained by the market are a lot more commercial and palatable to our clients. So ultimately, it's to the benefit of our clients. Now, in terms of course and construction builders risk policies, especially for the larger placements where we require a panel of insurers to complete a placement, what's benefit to us now is that we're seeing much more continuity of terms and conditions amongst the panels. During the hard market, unfortunately, we saw a lot more split terms and conditions amongst subscribers, whereas now we're seeing projects being placed with consistent terms for the entire program, which is very positive.
Well, of course, Chris, no matter how good the capacity is, there's always a balancing act for brokers, isn't there, with their clients in terms of what they need versus what they can actually get.
That's right, Paul. So we're working in a more pragmatic market where we're able to really think about what we need, what do we want, what is our risk management or risk transfer goal, and we're able to find that. So we're able to determine, what is the most efficient retention, what sort of coverage extensions or enhancements do we want? Do we want to be innovative? Do we want to have integrated layers of coverage? Those are all on the table now, and they weren't before. I think the other thing would be with more small and mid-market business, we're able to find capacity that's dedicated and designed with certain coverages that are better than market. But what I will say is it's not a return to the previous soft market. That grant or that offering from the insurers is going to be predicated on rigor, on risk management rigor, on doing the right thing, which I think sometimes didn't maybe necessarily happen in the soft market when we saw a race to the bottom to some degree. So that's my thoughts.
Yes, obviously capacity is increasing then, Chris, but have there been any new coverage options that you've seen introduced this year? And if so, what's made them stand out?
I would say not really. What we are seeing is a return to offering some of the coverages and some of the enhancements that previously were offered, and then certainly went away over the last 4 or 5 years as insurers sought to really tighten up what they were offering. Examples of that could be difference in deductible coverage found under an installation floater that could be used to buy down a large builder's risk deductible. That hadn't been available for 4 years. Certainly it's now available, which is good. And I should say, when we say things are available, it's not available to everyone. Insureds do still need to demonstrate that they can manage risk, that they can deploy certain technologies that help mitigate risk exposures. I think that'll remain, and insurers and brokers are going to have to really work together to make sure that continues to evolve.
Well, if there is more availability in general, then, Colin, I guess the message to brokers is to revisit some of these coverage enhancements and extensions.
Absolutely. We're seeing, to echo Chris's comments, there's a much more openness from the insurers and markets to entertain discussions about coverage elements that were off the table the last 3 years, such as multi-year rate guarantees, no claims bonuses, or to increase coverage elements such as contractors rework coverage. So we're seeing a lot more openness from markets to entertain these items that were non-starters for during the hard market cycle. But to add upon that, we are seeing in the E&O space some change in policy forms or introduction of new policy forms, which are better suited for new delivery models that are starting to take hold here in the Canadian market. We're seeing E&O policies forms that are better suited for integrated project delivery models, as well as progressive design build models. So it's exciting to see the industry adapt to the change in the construction industry when it comes to how projects are being delivered.
Well, Colin, as it is your first time with us, I thought I'd give you an opportunity to send a message to the market. So as a broker, what do you wish your construction insurer partners knew or did differently? What do you think?
It's a great question. We could probably speak for many minutes on this one, but I'll keep my answer brief. Really, the key for me is to communicate to markets the importance of being able to underwrite an account and approach it on a much more holistic relationship level. It's not just about underwriting and provide terms for an individual line of coverage. It's about, as a company, as an insurer, seeing how they can provide a full suite of services and multi-line solutions, particularly for those construction accounts in the mid to upper large market space that might not necessarily have in-house risk management. By providing multi-policy quotes, by offering added value services such as reviewing insured's health, safety, environment policies, looking at their quality control, quality assurance policies, providing or offering fleet risk management services, that not only differentiates insurance, what they're offering in a very competitive market, but also help fosters that relationship and hopefully a long-term relationship with the insureds, which is the benefit to everyone.
All right. Well, Colin's taken quite a nice stance there, a nice approach to this question, I think. Chris, are you going to be equally nice, or have you got something a little harsher lesson for our insurer partners to learn?
I would say constructive. I would say I've got something more constructive. So the best construction underwriters, best insurance companies that write construction, their people understand means and methods of construction. And they also have in-house engineering capability, and they use that in-house capability to find ways to understand projects and write that business. And I think that's the real differentiator that we see in the marketplace. The insurers that have invested in that are the insurers that write that risk best and know the market and develop the best relationships with their clients as well, through the brokerage. I think that's really critical. So if we see that, what we find is there's usually better alignment and better outcomes for both the insurance company and the client. So it's not necessarily that I'm looking for huge changes, but I'd like to see more specialization and more investment in certain capabilities and capacity. I think that'd be really good, and we'd see the market maybe continue in a more stable environment if that was the case.
Well, a final question for you both. Scary as it sounds, we are edging ever closer to 2025. And as we look ahead to that new year, what is the main trend or issue that you think construction insurance brokers need to be aware of, Chris?
I think that we're going to see a continuation of this market. I do believe that the tenets of this market have been, pragmatism and thoughtfulness. There has been, of course, a return to entrepreneurial spirit, and their insurers are trying to write more business. But I do think there is a risk management rigor somewhere there that they're trying to grapple with. I do think, though, that there are certain segments that are going to continue to struggle. Wood frame, as I mentioned earlier, we're seeing losses. I don't know that anyone really can find sort of a systemic issue that's causing those losses. So it's going to be difficult to put your finger on a real understanding of how best to write that business. So you're going to see the rates continue to kind of bounce around. That's challenging for our clients. It's challenging for the insurance companies. It's really challenging for the brokers because you want to have some certainty when you're dealing with your clients. The second would be mass timber. Mass timber is talked about a lot. We're seeing projects be discussed a lot. We talk about capacity and the ability for insurers to write mass timber, but I don't know that there's a real true, common understanding of all the risks that are entailed by mass timber. Whether that's supply, whether it's manufacturing, whether it's post-loss, how to deal with different things. I think that's always going to be something that needs to evolve, and there's a lot of work needs to go into that. And then finally, I think the professional liability and specifically project-specific professional liability space is going to continue to be a challenge. You're basically trading dollars for limit, and we're not seeing a lot of softening or improvement in coverage because, frankly, the losses aren't improving. So it's going to continue to be challenged, I think, going forward. But I have some hope that we'll find some better solutions for all three of those. But I think in general, we can expect a very stable market to 2025.
All right, well, Chris has covered a lot of ground there, Colin, but any trends that stand out for you as we go into the new year?
Well, I think we're going to see a divergence in the rating environment. We talk about general terms such as a softening of the market or a hardening of the market, but when it comes to the construction industry, I really think we're going to see a divergence. The casualty market has been soft and continues to soften. So a challenge for us will really keeping our finger on the pulse of what is that rate environment looking like on the casualty lines as with new capacity and new players entering the market. I think it's going to be to the benefit of our clients and insureds. But as Chris has already mentioned, there are segments within the construction industry that are challenged, where rates are either stabilizing or there's actually some increases that are being applied. So as a broker, it's going to be very imperative that we work with our clients to work ahead of renewals, come up with a strategy that fully contemplates the evolving and ever-changing rate environment, which isn't a general trend. There are micro trends within the sector. So it's just being aware of that and being able to communicate those trends to our clients so that they can prepare internally for what the renewals will look like.
Well, fantastic insights from you both. And indeed, huge thanks for your involvement and huge thanks to the involvement of all of our panelists from this past year. And this isn't the end, folks. We will have more construction insurance discussion in 2025. So watch this space. And until then, keep it right here at Insurance Business TV.